Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at AMD.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine seeing a stock just go on this historic 12-day winning streak.
Right, breaking past $340 a share.
Exactly. And realizing it's all because the company systematically killed its old identity. I mean, we really need to completely erase that mental model of them as just this, scrappy supplier of cyclical PC parts.
Oh yeah, or those budget gaming chips. Those days are completely over.
They really are. What we're looking at today is a structural transformation. They've become the indispensable, absolute, must-have second source for global AI infrastructure.
And you know that identity shift, it's really the only way to understand the wealth-building context of what's happening right now. We are looking at a historic market breakout, but, well, it's not running on hype.
Right, not at all.
It is running on massive margin expansions driven by a CPU renaissance, plus a highly unusual equity mega deal with Meta. And honestly, a fundamental misunderstanding by retail investors of a seemingly terrifying triple-digit price-to-earnings ratio.
We have to start with the financial foundation, because momentum means nothing without the balance sheet to back it up.
Absolutely.
Looking at the fiscal year 2025 numbers, they posted record revenue of $34.6 billion.
Right.
That's a 34% year-over-year increase.
Which is massive on its own.
Yeah, but that raw top-line number kind of masks the real story, which is the internal mix shift. The data center segment is now the undisputed engine of this company.
Oh, without a doubt. It hit $16.6 billion in fiscal 2025, which is up 32% year over year. To put that into perspective for you, the data center business now accounts for roughly 48% of the company's total revenue.
Almost half.
Exactly. For years, servers and data centers were just a side quest while they battled for consumer desktop dominance. Now, it is the core identity.
And the acceleration is just compounding. I mean, in just the fourth quarter of 2025 alone, data center revenue hit a record $5.38 billion.
Driven heavily by their ePYC server CPUs and the massive ramp-up of the Instinct MI300 accelerator.
Right. But revenue growth alone doesn't trigger a 41% stock rally.
Yeah.
The real wealth-building trigger here is the margin expansion.
Yeah, the margins are incredible.
It reminds me of like a popular local restaurant pivoting exclusively to high-end private event catering. The total number of plates served drops, but the profit on every single plate absolutely skyrockets.
That is a perfect analogy. The high-end catering in this scenario is high average selling price data center silicon. Because they are selling to massive enterprise clients rather than individual consumers, their gross margins expanded to 52% in fiscal 2025.
Which is huge.
It is, and management is openly guiding for roughly 55% in the first half of 2026. When you combine billions in new top-line revenue with profit margins that are expanding that aggressively, you create this compounding effect on the bottom line.
And that's why analysts are projecting, a 59% jump in earnings per share for fiscal 2026?
Exactly. They are basically printing cash right now. And more importantly, they are sitting on a fortress of a balance sheet. They closed the fourth quarter with roughly $10.35 billion in cash and equivalents.
Wow.
Yeah, their net cash position is $7.33 billion. Effectively, they're completely debt-free on a net basis.
Generating a free cash flow margin of about 19.5%, right?
You got it.
So in an industry like semiconductor development, which we all know is famously capital intensive, I mean, where a single fabrication mistake can cost billions, what does having zero net debt actually unlock for them?
Well, it unlocks the ability to play pure offense, while their legacy competitors are forced into defense, In semiconductor engineering, R&D is astronomically expensive. You are designing architectures years before they ever see a silicon wafer.
Right, the lead times are crazy.
Exactly. So having zero net debt means they aren't bleeding hundreds of millions of dollars every quarter just to service interest payments to bondholders. They take that massive free cash flow and funnel it straight back into R&D for the upcoming MI400 and Zen 6 architectures.
Right. Compare that to competitors who are currently bogged down by immense financial constraints and massive debt loads.
And painful corporate restructuring, yeah. A debt-free balance sheet allows you to aggressively outspend the competition on innovation.
Which means all that R&D cash actually has to translate into superior hardware. And they really bought a physical moat, and the market share data proves it's working.
It really does. Look at the server CPU market. They currently hold 28.8% of the total unit share. But look at the revenue share.
Right. In the fourth quarter, they captured a record 41.3% of the revenue
Yes,
share.
exactly. If you only control 28% of the actual physical volume being shipped, but you are taking home over 41% of the total money spent in the entire industry, that means you are the only one selling the luxury goods.
The premium tier.
Right. That disconnect between unit volume and revenue share is the single most telling metric in their entire earnings report.
Because customers aren't just buying their chips, they are actively choosing the most expensive, highest performing chips in the catalog.
Precisely. They are dominating the high core count server market where the margins are the absolute thickest.
So that covers the CPUs, but the explosive growth, the part that has Wall Street entirely captivated, is the AI accelerators.
The MI450 architecture.
Yes, specifically its memory configuration. I mean, we are staring at specs featuring HBM4 memory with 432 gigabytes of capacity and 19.6 terabytes per second of bandwidth.
Which is just staggering. To give you a direct head-to-head comparison, that is 2.25 times the capacity and 2.4 times the bandwidth of Nvidia's flagship B200 chip.
Wow, so it allows AI models that are 50% larger to run entirely in memory.
Exactly.
Oh wait, let me push back on those specs for a second. Usually when people talk about AI chips, they obsess over raw processing speed, like how many calculations a chip can do per second. So why are they hyper-focusing all this engineering power and capital into memory capacity and bandwidth? Is memory really the bottleneck for these tech giants?
That is the perfect question. To understand the engineering choice, you have to separate AI workloads into two distinct phases. You have training and you have inference.
Okay, so training is the brute force phase.
Right. That is when you feed a neural network billions of text documents or images to teach it how to understand language or recognize patterns. That phase requires raw, unadulterated processing power.
Got it. And inference is the second phase.
Yes. Inference is when the AI is actually deployed to the end user. It's when you open an app, type in a prompt, and the AI generates a response.
So inference is the commercialization phase. It's the day-to-day usage of the model that these companies actually monetize.
Exactly. And inference is almost entirely memory-bound. Think of how a large language model generates a response. It predicts the next word, one token at a time.
Right.
But to predict that single word, the processor has to load the entire parameter weight of the model from the memory banks into the compute core.
Which, for a trillion parameter model, is just an unbelievable amount of data.
Traveling back and forth for every single syllable the AI speaks? Yes. Think of the processor itself as a brilliant speed-reading scholar and the memory banks as a massive library.
Okay, like that.
It does not matter how fast the scholar can read the books if the hallway connecting the scholar to the library is a narrow, single-file corridor.
The scholar just ends up standing around waiting for the books to be delivered.
Yeah.
So the bandwidth, that 19.6 terabytes per second, is the width of the hallway.
Exactly. They bypassed the narrow hallway and built a multi-lane superhighway. By giving the chip 432 gigabytes of capacity with that immense bandwidth, they allow massive AI models to live entirely inside the chip's immediate memory.
So they never have to reach out to slower external storage servers to fetch data.
Never. They have solved the exact structural bottleneck that the trillion-dollar hyperscalers companies like Microsoft, Google, and Meta, who run these massive cloud ecosystems, are desperately trying to overcome.
But they aren't just attacking the hardware bottleneck, are they? They're attacking the software and ecosystem lock-in, too.
Yeah, with the UA-Link interconnect standard.
Right, because right now, the dominant player in AI hardware uses proprietary networking. If you buy their chips, you have to use their networking gear, their software stack, basically their entire closed ecosystem.
It's a walled garden.
Exactly. But UA-Link is an open standard. It gives these hyperscalers an escape route. It allows them to mix and match hardware and build out data centers without being held hostage by a single vendor's pricing power.
And hyperscalers are heavily incentivized to support open standards because they despise being dependent on a monopoly. That technological advantage, the memory bandwidth, combined with the open ecosystem approach, is exactly what is driving the massive institutional accumulation of the stock.
And we saw that accumulation play out in real time with a historic technical breakout. 12 consecutive winning trading sessions, resulting in a cumulative gain of 41%.
It completely shattered the previous 52-week high, reaching levels near $347.81.
The longest winning streak since 2005. That's insane.
A relentless multi-week advance of that magnitude requires billions of dollars of sustained capital inflow. You aren't looking at a retail frenzy or day traders chasing a trend.
Right, this is big money.
You are witnessing a structural re-rating by institutional portfolio managers. The largest funds in the world are rebalancing their portfolios to ensure they have massive exposure to this specific infrastructure.
And the clearest signal of that institutional adoption has to be the Meta mega deal.
Oh, absolutely. A 6-gigawatt agreement for AI infrastructure is staggering on its own.
But there is a financial instrument buried in this contract that is highly unusual for a standard vendor agreement. The deal includes a performance-based warrant for up to 160 million shares.
Which is huge.
It is. Most companies just pay cash for servers. So what exactly is a performance-based warrant doing in an infrastructure contract, and what does it mean for the relationship between these two companies?
Well, a warrant gives the holder the right to purchase shares of the company's stock at a specific locked-in price at a later date.
Okay.
By structuring the deal this way, Meta is not just acting as a customer buying silicon. They are essentially taking a vested equity stake in the manufacturer.
So if the chips perform as promised and the stock price appreciates, Meta stands to make billions of dollars purely on the execution of those warrants.
Exactly. It completely aligns the financial incentives of the buyer and the seller. Meta is now financially motivated to see this hardware succeed in the broader market.
Effectively turning the world's largest buyer of AI infrastructure into an institutional champion for the stock. That is a brilliant hedge for Meta, and just an incredible vote of confidence for the hardware.
And this adoption goes beyond just the big tech hyperscalers, too. The public sector is aggressively entering the AI arms race.
Right, like the multi-year deal signed with the French government to support the Alice Lecoq exascale supercomputer.
Yes, the European Union is pouring sovereign wealth into building independent AI infrastructure, which opens up an entirely new, high-margin revenue stream that isn't dependent on American tech corporations.
And analysts are looking at these massive multi-year contracts and just rushing to revise their valuation models.
Oh yeah, D.A. Davidson upgraded the stock to a buy with a $375 price target.
Which alone spurred a 12.4% surge in a single trading session.
Right. Bernstein raised their target to $265, specifically citing the structural mix shift toward high-margin data center products.
And UBS maintained a $310 target, while actively noting the high probability that Microsoft will be the next hyperscaler to sign a mega deal, joining OpenAI and Meta.
Exactly.
So when you look at the psychology in the market right now, how much of this price action is fundamental validation of the hardware, and how much is just pure unadulterated fear of missing out from funds who were late to the trade?
Honestly, it is a feedback loop of both. Hedge fund managers understand the scarcity value of high-end AI compute.
Right.
There is a finite amount of advanced packaging capacity in the world to manufacture these chips. When a company demonstrates a massive technological moat and starts locking in the biggest buyers on the planet, sidelined capital is forced to act.
Because portfolio managers are evaluated on their performance against benchmarks.
Precisely. If a critical piece of global AI infrastructure is breaking out to all-time highs, they simply cannot afford to miss the inference inflection point without risking their own clients' capital.
But look, if I pull up a stock screener right now, the trailing price-to-earnings ratio is sitting somewhere between 93 and 1 of 15.
Yeah, it looks high.
For anyone managing their own portfolio, that number is a blaring siren. A PE over 100 usually implies a stock is priced for absolute perfection, or worse, caught in a massive speculative bubble. So how do we distinguish between an overvalued bubble and a metric that is simply lying to us?
That's the key, right? A trailing PE ratio is inherently backward-looking. It only tells you what the company earned over the last 12 months.
Okay.
And in this specific case, the last 12 months were heavily distorted by two massive one-off financial hits.
Right, the inventory correction.
Yeah, first, the broader semiconductor sector went through a severe inventory correction in early 2025, temporarily depressing sales across the board.
And the second hit.
Far more significantly, the company had to absorb a $440 million export charge related to the MI308 chips that were destined for China.
Let's contextualize that export charge for a second, because it isn't a failure of the business model.
Not at all.
The United States government places strict regulatory caps on the raw interconnect speeds and processing density that American companies are allowed to export to certain foreign nations, specifically citing national security concerns.
Right, regarding foreign military and AI capabilities.
Under current regulations, they face a ceiling of roughly $100 million per quarter on what they can sell into the Chinese market.
So that $440 million charge was the cost of essentially unwinding inventory and swallowing the development costs for a market they are no longer legally permitted to service at scale.
Got it.
It was a massive one-time anchor dragging down their historical earnings. But the stock market is a forward-looking discounting mechanism. Investors don't buy past earnings, they buy future cash flows.
Right.
When you look at the forward PE based on projections for the next 12 months, it drops to a much more reasonable 40 to 48 times earnings.
40 times earnings is still a premium valuation compared to the broader market, though.
It is, but you have to contextualize that multiple against the company's growth rate.
Ah, right. We talked earlier about analysts projecting a 59% jump in earnings per share.
Exactly. When you take a price-to-earnings ratio of 40 and divide it by a growth rate of 59%, you get a PEG ratio, price-to-earnings growth, of roughly 1.6.
And a PEG ratio under 2.0, especially for a company aggressively capturing market share in a secular megatrend like AI, is actually considered incredibly healthy.
Very healthy. Furthermore, they are already mitigating the revenue loss to the China export caps by pivoting hard into those sovereign AI deals in Europe and prioritizing the insatiable demand from U.S. hyperscalers.
And those domestic hyperscalers and sovereign entities command higher average selling prices anyway, which structurally improves the long-term margin profile.
This is exactly why the institutional money treats the trailing PE as an illusion. The fundamental re-rating is based entirely on the MI450 supercycle.
Right.
And we don't have to rely purely on internal projections to know this demand is real. We have independent macro validation from Taiwan Semiconductor, TSMC.
TSMC is the foundry that physically manufactures the silicon wafers for almost the entire industry. They are the ultimate bellwether for global semiconductor demand.
They just released their Q1 earnings, posting nearly $36 billion in revenue. Crucially, high-performance compute, the exact category these AI chips fall into, made up 61% of their total sales.
Wow.
Because it takes months of lead time to secure capacity at a TSMC fab, their earnings prove that the world's largest tech companies are making massive, multi-year production orders for AI silicon. The underlying demand is aggressively accelerating.
So looking ahead to the catalyst calendar, what are the specific events of the next few months that could either sustain this momentum or completely derail it? We have the Q1 2026 earnings call coming up on May 5th. Consensus estimates are looking for roughly $9.84 billion in quarterly revenue.
The headline revenue number on May 5th matters, but institutional investors will be scrutinizing the margins and the forward guidance. They need confirmation that the 55% gross margin target is intact, and they will be parsing every word management says regarding the MI450 production pipeline. Any hint of manufacturing delays or supply chain bottlenecks in acquiring that advanced HBM4 memory could trigger volatility.
But the truly massive event on the horizon is the Advancing AI 2026 showcase in July. The expectations building around this event are just sky high.
Oh, they are.
There are credible hints that the company will officially detail the next-generation MI500 series, with claims of a 1,000x increase in AI performance.
July is when they outline the roadmap for the rest of the decade. They will provide the deep technical specifications into architectural leaps, expected production timelines, and early benchmark results.
That is the raw data that Wall Street analysts require to build their earnings models out through 2027.
Which highlights why large funds view this stock as a multi-year hold. You do not trade in and out of a position like this trying to capture a single quarterly earnings beat.
Right. You build a position to capture the full economic value of the MI450 deployment, the transition to the Zen 6 server architecture, and the multi-trillion-dollar build-out of global AI data centers over the next 3 years.
Exactly.
So synthesizing all of this, we're looking at a company executing one of the greatest pivots in technological history.
Yeah.
They are a structural buy positioned perfectly on the right side of the AI adoption curve. They built a pristine, debt-free financial fortress that allows them to aggressively fund R&D.
And that capital created a massive technological moat.
Yeah.
Specifically, that 19.6 terabytes per second memory bandwidth advantage of the MI450.
Which solves the exact inference bottleneck plaguing the industry. And this superiority is translating into market dominance, evidenced by capturing over 41% of server revenue share and securing vested equity partnerships with giants like Meta.
The seemingly terrifying valuation metrics are really simply a mathematical distortion from past inventory corrections and geopolitical export rules, masking a highly attractive forward growth profile.
It is a masterclass in capital allocation and engineering execution, arriving at the exact moment The global economy demands high-performance compute.
Perfectly said.
But as we close today, I want to leave you with a broader strategic question to mull over, one that stretches beyond the hardware specs and stock charts. We discussed how they are championing open standards like UALink, effectively building an escape hatch for companies trapped in proprietary, closed-loop ecosystems.
Right.
As these trillion-dollar hyperscalers spend the next decade building out the foundational layer of human computing, how will this open-source approach fundamentally shift the balance of power? If the underlying infrastructure of artificial intelligence becomes entirely open and interoperable, who really holds the ultimate leverage in the future of the tech industry? Thank you for joining us for today's wealth-building conversation. We will see you next time.